This is Let's Talk Business with your host, Marc Ebinger. Now, here's Marc.
Welcome back to the Let's Talk Business podcast. Coming up on the show today, we're going to talk about setting up your own personal banking system through the use of specifically structured whole life insurance policies that can be borrowed against. This, I have been strangely excited about the research that I've done on this topic, and I'm excited to talk about it with Colonel Mike. So in studio with us today is Colonel Mike Connor, a retired U.S. Air Force colonel with a NNI-authorized IBC practitioner and real estate investor. Colonel Mike, welcome to the show.
Thank you, Mark. And for the audience, I'm Colonel Mike from Headquarters Becoming Your Own Banker, and we specialize in helping entrepreneurs and small business owners take control of their money and their borrowing function.
Yeah, which is, I think, a big deal, right? We were talking off camera about how kids in school should be taught this stuff at the youngest age possible, because the quicker you get on it, the more empowered you are.
And I don't know how it is at your household, but I, as a parent, try to teach my kids that, but they don't want to learn from me as a teacher, from dad. So I think, yeah, you're right. School should be teaching.
Yeah, absolutely. I mean, school wanted the responsibility to teach my kids. How about we teach them how to deal with money? Is that too much to ask? I don't know. All right, I'm your host, Marc Ebinger, the owner of Krukus Virtual Staffing, a company that recruits and staffs experienced overseas administrative assistants for insurance agents and attorneys. If you're curious about the most common tasks that VAs are doing for their businesses, head over to our website at krukus.com and grab a list of the top 20 tasks that VAs are doing for businesses like yours. The link is in the podcast description.
All right. Thank you, Mark. And I'm Howie Nestel, a co-host at Let's Talk Business podcast. I have been the owner of Sharkmatic Advertising for 3 decades. And if there's something that I learned from having worked with 1,500 clients, is that all businesses struggle with marketing. It didn't take us all 30 years to develop a signature approach to communicating messages effectively and economically, but those are 2 key ingredients that all clients who look for a marketing agency should be interested in. Our clients, I'm proud to say, are doing better than most of their competitors, and it's a team approach. So if you are curious about how we can help you grow your digital influence, go to sharkmatic.com and reach out to us, and let's get together.
Right on. Speaking of teams, I work with teams. So I'm Alan Utley. I'm a work-life speaker and coach with My Coach Next Door, 25-year HR executive. I work with growth-minded individuals, leaders, and teams to help them discover how to harness their natural talents so they can get unstuck and thrive in their work and life.
You need to roll in your Instagram or whatever. So is there like a specific place where people can go and follow you on social media?
Yes, a TikTok and Instagram at My Coach Next Door.
Yeah.
Yeah, come check it out.
It's
I do
good
a
stuff.
lot of content on toxic workplaces and leadership.
Oh, yeah.
Yeah, I also like the way you disagree with other marketing experts.
Wasn't that hilarious?
That was great.
Did you watch that stitch?
I loved it. I loved it.
Great, dude. Do more of that.
Yeah.
He actually, his not his follower count, but his viewership went down when from what he's normally used to.
I
when he
texted
stitched
everybody.
it.
I texted all my contacts to unfollow him. That's why.
That's why
You
it
think
went
that was
down.
a coincidence?
No,
No, man. This is a battle. No.
There's no
I'm
room
kidding.
for disagreement.
But great info. I enjoyed listening to you. Really, I do. And I love the fact that
good,
you're in
right?
the car and you're just like, hey.
Yeah.
Was that the first time you've seen his stuff?
No, I had seen his stuff before,
Okay, all right.
but I wasn't paying as close of attention until I got
So you
That's
gained
funny.
it
I've never
until
seen
I
you
got
like it or
stitched.
comment or share it.
stitched. It's my. I have to check with my Krukus administrative assistant from the Philippines about why that's not taking
Why
place.
that's not taking place. Oh, well, at least you got 2 followers. You got 2 new
fantastic.
followers
Yeah.
since you've been
And they're
doing
real
your thing.
humans right here in San Antonio.
That's right.
We're not algorithms.
All right, a quick reminder to follow the Let's Talk Business podcast on all major podcast platforms and social media, where you can catch video versions of the show and a little bit of Alan Utley and Howie Nestel. Loving the stitch in there. You can get to everything easily from our website at satalkradio.com. All right, Colonel Mike, so give me a little bit about your background, that kind of 90 seconds of your background that led you to where you're at now with respect to helping people be their own banker.
So I retired from the active duty Air Force in 2003, and I lasted a little over a year as a DoD contractor before I did what I think my clients did. I took control of my income producing function as a real estate investor in a small town in South Carolina. We started in January 2005. I had a ball for the next 4 years, a property or a deal a month in a small town of 30,000. It was going great until it wasn't. And then the golden rule kicked in. And he who had the gold decided that my HELOCs were frozen and I couldn't borrow against them anymore. I could just pay them off. And my business credit cards went from 9% interest to 24% interest. And I had all of my savings and another $750,000 worth of private lender funds in real estate. So I just had to eat those higher payments until I could get it paid off. And about mid-2009, it was clear we weren't too big to fail. And on April Fool's Day of 2010, I became a DoD contractor again after 5 years of being an investor. And that sucked. That's what brought me here to Brook City Base, managing big military construction projects in Afghanistan. And then to pay back my private lenders, I actually went to Afghanistan for a year and a half to make the bigger bucks. And I still don't tell any of those stories to my family. And part of the time I was outside of the wire, which even made it even funner. It was a total of 5 years before I got back to real estate investing here in San Antonio. And during that time, I developed my top 2 financial goals. Number 1, screw the IRS. And number 2, screw commercial lenders. And becoming your own banker does both of those. It puts you in control. It helps you grow wealth, tax deferred, at least tax-free if you don't screw it up. And then it gives you control of your borrowing function.
You know, we're not talking about anything new here, right? I mean, this has been around a while. The concept that you guys are talking about, being able to leverage whole life insurance in order to borrow against that kind of stuff, has been around for a while. Am I correct?
Plain vanilla whole life insurance, you could borrow against the new aspect of it, what Nelson Nash says he discovered. It always existed, but there's a way to specially design the policy. So it has high cash value early on, so you're not waiting a lot of years before there's enough to borrow against. So with the Becoming Your Own Banker program, you pay what seems like a high premium, but you can borrow against that premium within 30 days of funding your policy. You put it to work any way you want to. You're the banker. You're in control of the terms and the repayment schedule. And it's a forced savings plan because we all suck as savers right now.
Well, we're going to break this up into bite-sized pieces, I think,
Okay.
a little bit. But let's back up a little bit to what is the NNI authorized IBC? Can you just define that for me?
Right. So this book, Becoming Your Own Banker, and it was authored by Nelson Nash, published about 25 years ago. Nelson discovered this, the capabilities of these special design policies back in the 1980s after a real estate crisis. And then he started teaching it, and then he wrote his book. And when the team got formed around him, they developed a Nelson Nash Institute. It is an educational organization. They don't sell life insurance. And they want to make sure that insurance agents honor Nelson's development of the process, and that if the public comes to us for one of these policies, we're going to design it the way that Nelson intended it to keep them safe, but to also help build generational wealth for their family.
Hey, Colonel Mike, let me ask you this. So if I got the timing right, you became a real estate investor in the early 2000s. So when things went wrong, was that 2008, that economic collapse?
Yeah.
Okay. So obviously at that time, you hadn't read the book. This was not on your, this was not in your sights. Now that you have implemented this and used it, how has that helped you in your real estate investing since during the pandemic and since the pandemic and leading up to it?
Good. And I like that question. Now, what I did learn back in the early 2000s from real estate gurus is that when I buy a property, my seller should be my bank when I buy. And then when I sell, I should be the bank to my buyer. That I'd be a flipping idiot if I just sold it outright, because I put all the work in to get the property and fix it up. And so that guru pointed out that banks have the biggest buildings in most cities because they're using other people's money to finance everything that they're doing and then making big profits on top of it. And he said, look, we're in the finance business. It's just with houses. It's not with cars. It's not with furniture, it's with houses. So being your banker that way made perfect sense, except for I didn't believe it at that point. When I restarted in 2015 here in San Antonio, after getting my butt kicked in South Carolina, my wife said, look, the only way you can do this is if you don't borrow any more money. And so I took the challenge. And the first deal that we did here in town, and it's called a non-qualified assumption or a subject to, was from an Air Force retiree who was a government employee, and he had taken a job in Ohio, and he had a house back here he couldn't sell. And I did that deal with him over the phone. I never met him until he flew back to San Antonio to get his 20-something-year-old sons out of the property, and then we took it over. His loan stayed in place. He even made the next 6 payments. And then we did the rehab, and then we did a seller finance deal and helped a deserving family become homeowners. So that was the start of us following that system. And then it was still another 4 or 5 years before I learned about becoming your own banker. And then I did the forehead slap and went, holy cow, this is the financial foundation for every family. This is the stuff we should be teaching in high school, teaching financial discipline, making saving more like a bill you pay, because we'll pay our bills. We won't save for our future. Well, this accomplishes the same thing.
Well, but to Howie's question, I think he's trying to explore, has it been successful for you and to what extent?
So we use our system of policies, and between my family of 6, we have 9 of these policies. We currently pay $295,000 a year in premium. So those 4 kids I was telling you about between 26 and 30, they have 5 policies. They pay $95,000 a year in premium into their banking system. And holy cow, I'm proud. That you asked if it gets easier with kids after they become teenagers. Well, they started listening in their 20s, and they shocked me. They did what I recommended that they do. And then between my wife and I, we pay $180,000 a year in premium on 4 policies. So when we want to do a real estate investing deal, we have our own banking capacity. We can take a loan at will from our policies, and we often will take $30,000 to $50,000 to reinstate a loan or to make the purchase, then do the cosmetic rehab. Oftentimes we'll sell or finance it. We'll get a 20% down payment. That'll fill our system back up again. And then the cash flows off the property are premium payments going back into our banking system. Okay. And it just keeps getting
Let me
better.
close the loop on this real quick. So you're paying $190,000 a year in premiums on your life insurance policies. Is that correct?
Between my wife and I, we have 4 policies, $180,000.
$180,000. Okay. Are those premiums being paid by your property investments? 100% of those premiums being paid by your real estate investments that are going on? Did I understand that right?
I'm an Air Force retiree, so I have income coming in from that, but through our income from the real estate, from my retirement, from me acting as a Nelson Nash Institute authorized practitioner as a life insurance agent.
Let me ask it another way. Are you receiving more revenue than $180,000 from your investments?
Oh, yeah.
Okay. Yeah. So it's basically self-funding is the point I was trying to get at.
So as someone coming in, I'd say pretty new to this whole concept, I only just learned about it from meeting you recently and did a little bit of reading on it. It sounds like, from what I see, a high barrier to entry from a cost perspective. The premiums seem high, and perhaps I'm wrong, and there seems to be a complexity too. So as someone who's very much a novice in the financial space, can you explain how would I even get involved and get started in something like this? How would I even get the funds to get started?
And what's the buy-in?
Yeah.
Yeah. Where can you get started at?
So the question I'll flip just a little bit, and I'm going to give the answer to it, is we're not taught financial intelligence or education. I was a Dave Ramsey Financial Peace University facilitator at one point as well in the early 20s. But a savings rate of 10 to 20% of your income is the right doggone thing to do to take care of your future self. Most of us are so short-sighted that we spend every damn penny that comes in our pocket, and we think the government's going to take care of us in the future.
Like most people spend more than what they get.
Amen.
paid because that's why consumer debt is so high.
Unfortunately, they're
Credit.
paying. They're following the lead of our federal government,
Right.
which is wrecking us.
Yeah, the difference is that the government can print money, we can't. So we get into deficit spending, but then maybe we have to declare bankruptcy and try to wipe some of that out. But people don't generally get ahead, I think, if they're in debt to third-party institutions, which I think is the point here. So if you're going to be in debt, you're better off in debt to yourself, to your own financial instrument. Is that what you're saying?
But we're teaching financial debt. Well, first, we're asking people, do you like the results of the system you've created up to now? And do you recognize nobody's going to come and help you in the future? That you're accountable and responsible for yourself and everything you created in your lifetime. So it's time to start saving. And let's say median income, let's say it's $50,000. It's a little bit higher right now. And you're going to save 10%. So it's a little over $400 a month. That can be the start of a policy that we would specially design. We plan it to, and there's two different premium amounts. One, the planned annually each year that you're going to save for $5,000, but it's easy to add the capacity to save or pay another $5,000 in premium. So we would build a policy where you
That'd
could
be
pay.
a second policy. That's why you end
No,
up with
all the same policy.
same
That's
policy.
the special design. So you have the contractual right to pay up to 10, but you're only obligating at 5,000.
Gotcha.
So there's that 10% savings rate. Well, people find once they get started, they like the results of what they're getting, and then they start finding additional income. They develop a side hustle or something, maybe real estate. But then there's a place for that money to go into their banking system.
So let's talk about the components for just a second. So they're buying an insurance policy, right?
Right.
It's going to have, if something happens to them, they're going to make a chunk of money, right? Or their family will get paid a chunk of money. They can also borrow against whatever the current cash value of that policy is, correct? Which is going to be their premiums plus any dividends plus any interest that's earned on that. Is that all correct?
And you said it right. You borrow against. That cash value is collateral. It's not like borrowing from your 401k where the money comes out.
Right.
And so because you're borrowing against the collateral from the life insurance company, once you pay a premium, it's compounding for the rest of your life, tax deferred or tax free if you don't screw it up.
And you don't. If you borrow the money, you're not paying tax on the money that's borrowed, correct?
A loan is not income, so you don't pay interest on it. And if you're using it to buy a cash flowing asset like I do for real estate, well, the interest I pay the life insurance company is a tax write-off against the earnings from
So I
the
do have a
investment.
question. You said that unlike borrowing against your 401k, no money comes out of your life insurance policy, so that stays intact. Is that money invested in the market? Is it making something other than interest?
So it is not in the stock market.
Okay.
It's in very secure bonds,
Okay.
real estate loans or mortgages where there's a lot of security on it. And there's about 7 dividend-paying mutual whole life insurance companies that have been paying dividends for well over 100 years that are the companies that we go to put these policies in place. So they've been paying through World War I, through the Great Depression, the real pandemic in 1918.
The real pandemic.
Everything, Korea, Vietnam, the pandemic that just happened, they've been paying dividends throughout all of that. So that's where the safety and the security, because you can't lose your principal, you can't lose your premiums. There's guaranteed growth because by contract, the policy has to grow in value to reach the death benefit by the end of the contract. So it's guaranteed to internally keep growing. That's the nature of
and
life
so
insurance.
then when you pay back what you borrowed, are you paying an interest rate on that money? And who gets that interest rate?
So the life insurance company is lending their money, their pool of premiums. They have to put it to work. One of the ways they put it to work is by making policy loans available to their policy owners. The company we use the most, the interest rates are currently they're currently at 5%. Contractually, they can go to 8%. If the life insurance company can earn a greater and greater rate of return on their pool of premium as the economy gets healthier. And what we're seeing right now is a sign of a healthy economy coming back. When the interest rates were really low after the global financial crisis, that was a sign of
that it's
illness.
not healthy, right?
So as it increases, well, we don't want to harm the company because we're company holders as being policy owners. So we want to pay our fair share. If they can earn more someplace else, well, then the interest rate will rise once a year.
And then as an investor, can you still write off that interest as an expense?
Yes.
Okay.
Absolutely.
So what are what would you say the top 3 risks of this kind of a financial strategy?
All of the risk has to do with the human being that took out the policy.
Okay.
Yeah, so like you make bad decisions on how you invested that money or what you did with it or overpaid, is that what you're saying? Like, let's say if it was a home remodel, that you mean like human?
They lose their commitment to their new financial discipline and patience to build long term. So the only way that you can screw it up is by not paying the premiums. But even with that, if you funded your policy for several years and you haven't borrowed against all of your cash value, if you maintain your emergency fund, that's 6 to 12 months worth of operating expenses for your household and your business, if you've left that in your account and you hit a lean month or 2 or a year, well, inside your own banking system, you have the ability to borrow against it, and then you turn around and pay it right back into the premium.
Gotcha. But
Basically
Talon's,
whatever the interest rate is.
Yeah.
Talon's question then, well, what are some of the other risks? Okay, so you don't pay your premium. Do you lose your investment and do you lose your policy? What happens?
So
can you sell it in the secondary market? Can they go to Colonel Mike and have him pay the premium and then you're a partner in it? And then,
So there are those, not me, that buy, and I don't think any NNI practitioners that buy back or buy life insurance policies. But if you have outstanding policy, let's say you can't borrow against the policy, well, and you can't pay the premium. Well, what happens is the policy lapses or dies. Well, the loans, they're paid off. The life insurance company won't lend you more money than they know they're going to get paid back. So those loans are wiped out. And when I said tax deferred, unless you screw it up,
right.
And normally by year 7 or 8, for most policies we design, your cash value at that point is greater than every penny you ever paid in premiums. And then it just keeps getting much, much bigger after that. And for later, I brought some illustrations to show you how crazy it gets. Well, if you're in that period and you borrowed more than you ever paid into the policy, well, you've exceeded your cost basis. If the policy lapses, the IRS is going to say you got to pay taxes on that money.
Okay.
So that's worst case that could happen.
So do you need a nest egg of cash in order to start?
You can. It's best that way.
Okay.
But you can fund a policy monthly, quarterly, semi-annually. The reason it's best to start with a lump sum is the cost of insurance is what comes out first. So if you're paying monthly, it's going to be towards the tail end of the year before you would be able to borrow anything out of that system. With the lump sum payment, so let's say you funded a $10,000 policy. Normally, 30 days after you fund it, you can borrow up to $7,000 and go put that money to work. So I often have a client say, hey, I'm going to wait till I pay off my consumer debt before I get started. And they'll say, well, I've saved up this extra money and I'm getting ready to pay it. I said, well, hold on. Nelson teaches we should use every dollar that enters our financial system more than once before it leaves our financial system for good. So it's possible you take that lump sum, start your policy, take a policy loan at 5% interest, go pay that 24% interest credit card off. So now you've transferred that debt into your financial system, but now it's at 5%. You were used to making those monthly payments on the credit card. Well, be an honest banker. Make those payments back into your financial system.
Right. In other words, pay the same amount even though you're not obligated to, because then it's
Well, pay the same amount.
pay the same amount, right?
And you're going to
less
pay
interest.
that.
Yeah,
You're
less
going to pay that loan back sooner than you would have to the credit card company. Keep paying, but it now becomes premium for the next year. So that's where premium dollars come from. Is your budget's used to making these payments. It's just going outside of your system. When you direct them back in, then you discover you have more money.
So some of the best advice I ever got, and I don't remember who gave it to me, but I'm sure we've all heard it. Don't invest in something that you don't understand. Okay? And so I've done real estate, stock market, bonds, all kinds of investments, and continue to do them. The only times I've gotten in trouble in my life is when I invest in something I didn't understand or I didn't have all the details in. So if somebody wants to get started and they come to Colonel Mike, what are the steps? You give them the book to read, they hire you, do you advise them, do you coach them into it, do you evaluate their current position in life and get their mindset right before you design a plan for them?
And absolutely, and that's part of the commitment to the Nelson Nash Institute. And part of the benefit of dealing with a 65-year-old person who's had a lot of school of hard knocks financially. And so to start, in the Nelson Nash Institute, it has a practitioner finder. So there are people out searching the YouTube,
LinkedIn,
TikTok,
probably.
whatever out there. And there's a lot of noise out there on what this thing is. But eventually they hear about the Nelson Nash Institute. They go there and they can look and see it. Are there any authorized practitioners in my area? I'm the only one in San Antonio. And most military members, for sure, when they see a retired colonel, because this is a big town, we're connected at that point. So they call. I make sure they're reading the book, they're watching videos, and there's free videos on the Nelson Nash Institute website, and paid ones that those working with me, I give them a code so they can watch them for free. So they get educated, they start talking with me, I learn about their financial system and how long they're going to get after their financial life. And they will fill out a financial spreadsheet for me that has their income, assets, liabilities, and net worth. For a lot of them, it's the first time they've inventoried their financial system. And it's interesting or entertaining going through that with them. And as I'm talking to them and making sure that it's clear, they're accountable and responsible for themselves and their family. What are they going to do to take care of that? They realize they need to save more.
Yeah.
And that's where the commitment comes. And I can help design that starting policy. And I say starting because I told you my family has 9 right now, and number 10 is in underwriting. So as they get stronger financially, well, then they start to insure another family member and another family member, and the system
Gotcha.
grows.
Oh, so you have to have a specific family member that's insured or listed, and each person could have multiples, right? You can have multiple insurance policies for them?
Right. And so let me describe this whole life insurance policy. First, there is a policy owner. There is a policy payor. There's the insured person. And then there are the beneficiaries of the policy. The size of the policy is based on the insured person's financial production. That's what's really happening in a life insurance policy. Our most valuable asset that any of us have, we're sitting on it right now. Nothing in our financial lives happens unless we do something about it. And life insurance says, look, if you get taken off the playing field before it's your time, well, your income producing capacity is going to be provided to your beneficiaries tax-free to take care of your families, your loved ones when you're not here to do it. So and on top of that, and before I forget, there are health care benefits that come with this as well in this chronically ill country we've developed after we changed the food pyramids back in the 70s. So the healthcare riders will pay for something very similar to long-term care if you can't do 2 out of 6 activities of daily living. It will cover specified illnesses like cancer, stroke, cardiovascular disease. And when I say pay for, you can access portions of the death benefit, not your cash value, but the total death benefit, to pay for that kind of care. And the third one is a terminal illness. You can access the greater share. It'll still be a life insurance policy, but you can get access to that money to pay for living costs for the insured person. So they tricked us back in the 80s to buy term life insurance and invest the rest. And the reason that is really a stupid policy is most people didn't invest the rest. They took that much lower term life insurance policy premium, and they thought, well, I'm covered. What they didn't understand is they get in their 30s, they get in their 40s, and the longest a term policy goes is 30 years. So you're going to be 60 or 70. Well, term life insurance is damn expensive when you get to 60 and 70.
Right.
And you can't afford it. That means a lot of families die without a death benefit and without the investment.
Had it been stupid, though, a stupid policy or strategy, had people invested the difference, bought term and invested the difference, would you still have the same opinion? Or would you have... I'm not saying comparing it to whole life. I'm saying comparing it to not investing. I mean...
Well, that's an easy answer, really. It's a very easy answer. Because there were plenty that did. Plenty of baby boomers did that.
And what were the results?
And then the global financial crisis killed the stock market.
Yeah, right. And they lost 50% of their value.
And then it's killing it now during all of this inflation. And the joke is they become Walmart greeters or Sam Club greeters because they have to go back to work.
Well,
it's already been proven to fail.
The investments in the stock market aren't killing them or sending them to be greeters at Walmart. The pandemic did that. 2008 did that. One of the results was that their net value, their net worth in the stock market went down by 40, 50%. But had you stayed in, which is what most investors are told to do by financial gurus, then let's say just take 2008, for example. By 2010 and a half, you were already back making money. It's the people that got out of the market in 2008 after losing half their net worth. Yeah. But I agree with you. People will say, oh, yeah, I'll buy term and invest the difference, not invest it or not invest it properly. And then they have nothing to show for it, unless, of course, they die, before their term runs out, term life runs out.
Well, let me hit that for a second.
Yeah, go ahead.
So I'm the end of the boomers. And I can't believe it, but boomers that are older than I am that were counting and going to more fixed income kind of assets, and they needed that money to live on because Social Security is not meant to be a retirement plan. So when they had to withdraw to pay for the things of life and their medical costs and that kind of stuff, well, they had to take the principal out. So it wasn't there to wait for the market to come back up. And what the infinite banking concept does for you is it puts you in control. Every other financial institution out there says, we're not smart enough to do this ourselves. Let us give you our money. We'll give you our money, and then they take it and make lots and lots of money. And they pay us very little bit on the amount that we've deposited in the banks. And when we put in the stock market, the brokerage houses, they get paid, whether it's going up or down. And what we think is safe in the 401ks and the IRAs, well, they're just waiting to be taxed in the future. And we were told back in the 70s and 80s the tax rate would be lower. Well, that's not what our politicians are talking about right now.
Well, not only that, but the value of the dollar is less too. So you're kind of hit twice.
Because of the inflation of the Fed printing all the money that they're printing. Yeah, it's really, So taking control, being in control. And when this country was founded, we weren't here, but you could provide your own housing, your own food. There wasn't utility companies. You lived and died based on what you did to take care of you. And we've given that up for some government security of something that seems to be failing.
Well, speaking of government, what are the tax benefits of all of this? What versus just putting money in savings or doing some other kind of, I know it's a big question, but what are the obvious tax benefits of this?
So, and to compare it against, and not an investment. So this is not an investment. This is an asset like a high interest earning savings account or a CD or something like that. Except for this one comes with the death benefit and healthcare benefits. Your money is going to be multiplied where it's not in those other assets. Those other assets more than likely are taxed on the earnings. So it's not compounding tax-free. Inside of a whole life insurance policy, it compounds tax-free or tax. And we have to say tax deferred because if you screw it up, in that scenario I gave before, you're going to get taxed. If you don't screw it up, it's tax-free for the rest of your life. So that's the.
And what about, so go back to Mark's, piggybacking on what he's saying, are the premiums paid with after-tax dollars?
It is. Because if you paid with after-tax dollars because you wanted a tax write-off or pre-tax dollars, that means they'd want to tax the death benefit. And the death benefit is going to be so high, you're going to be
you rather
amazed.
pay for it with after-tax dollars so that the benefit itself is not taxable.
And
It's not taxable to your to the beneficiaries, correct?
Correct.
Okay.
Correct. So, for example, my 28-year-old son, we've got a policy and underwriting for him right now. It's planned to pay or save $15,000 a year with the contractual right to pay up to $30,000. And he intends to pay the full $30,000. And because life is a team sport, I'm going to make sure he pays the full $30,000 because if he's short, I'm going to give him the money, run it through his policy. He's going to take a policy loan and give me my money back in less than 60 days. So there is a team strategy or a family strategy that goes with this. Now, him starting at 28 and life insurance policies go till 121. Some of us may be living. My goal is I collect the tax-free death benefit at 121. His policy, his cash value and death benefit, by paying $30,000 a year for 30 years, that's the max he can pay into this. At 121, I think it's $18 million. That's what the compound, and 30 times 30 is 900K. Yeah, and I mean, the numbers are incredible with the compounding. And to be able to borrow against it tax-free and put it to work any way you want to. When I recommended my 20-something-year-olds start this process, they didn't have any significant others that they would insure themselves so that their significant other got the death benefit, and their mother and I didn't need it. I was the oldest in my family, so I said, look, you should take out a policy on my life. When I die, your money is going to be multiplied in a tax-free death benefit, and I'm going to feel good on the way out. That first year, their $10,000 premium, if I had been hit by a bus, would have been multiplied to $186,000. They could borrow $7,000 within or just after 30 days, and my youngest did, and he paid off his car loan. He just transferred the debt in his policy, and then he just paid back on that.
All right, so I'll ask you a question that I saw in the show The Office, and I see Dunder Mifflin on your cup. Is this a pyramid scheme? Is this, people are paying at the bottom, and then as somebody goes out, they take the money that other people paid, other than what the company made in terms of investing the money and getting a profitable return. If they're taking $900,000 in premiums and paying out $18 million, they didn't make an $18 million profit on that money. They're also using other people's premiums. Am I correct?
Sure. And that's the nature of any insurance. You spread the risk among everybody that's insured. And early on, take that policy I described. They paid $10,000, but if I had died the day afterwards, the life insurance company was on the hook to pay $186,000. So part of what the life insurance companies do and have to do is they are buying insurance on that insurance policy in case of that. But and remember, these companies, I've got policies with Penn Mutual. I think they've been paying dividends for 165 years, and with Lafayette Life, and they've been paying since 1905. They're pretty bad pyramid schemes because they haven't disappeared yet. So there are no good deals in life insurance. There are actuarials that they know their numbers, they know their risk, and they know how to invest the money conservatively for the long run. So no pyramid scheme that I'm aware of.
All right.
Yeah, he handled that question well.
He did. By the way, I love what you said about life as a team sport. I'm going to borrow that. But I have a question about access. So working in human resources, work with organizations that provide benefits, and you always see there's access to insurance policies. I don't know that I've ever seen this kind of financial tool available through employers. So why not?
Because of the cost. Because an employer is working a low-cost solution for their employees, because their employees get the death benefit. And a group term life insurance, and Mark and I had it in the Air Force, serviceman group life insurance. It's back then it was $18, $19, $20 for like $400,000 worth of insurance, and it covered a couple $100,000 on your spouse as well. The risk that any one of your employees or a military member was going to die was pretty low. We're a fit fighting force. I mean, unless it's a conflict or something. So a term life insurance policy, group term, actually is the most profitable product that a life insurance company sells because it seldom pays a death benefit. It's just, it's mainly cash flow. Right. And then for the unexpected, somebody does actually die. Well, the death benefit goes out, but it's very profitable for the.
And what you're saying is that for employers, term life insurance is going to be the most cost-effective way to do it, not whole life policies. So that's why they're not being offered.
Well, and to be clear, and the employers aren't doing it to be nice. It's coming out of the employee's salary. It's their total compensation package. There's no good deal from an employer.
Yeah, you have to opt into it. You pay for it as the employee. It's just being made available through their relationships.
So why not offer that? It's an educational moment, right? For them to be able to, for the employee to understand what's going on. But if you had to choose between the two, one is a higher cost, right? Because it's a heck of a lot more to pay $400 or $500 a month than it is, $35 or whatever the term life insurance.
Yeah, I mean, I could be wrong, but I don't think I've seen whole life insurance policies.
I haven't seen it
available. Yeah, it's usually a term.
No, the number of people actually exploring this concept is relatively low because we've been taught, hey, you'd be smart to go buy this cheap term life insurance, and you're covered.
And that's my other question. You mentioned, and it's great for you, you're the only IBC practitioner in San Antonio. Why aren't there more? Where are they?
Why aren't there more practitioners?
Yes.
Well, and that's great. And I'll tell you that 28-year-old son of mine, who happens to be a tactical air control party member in the Texas Air National Guard, so a special ops kind of guy, he finally came back after getting his ass whooped physically and mentally for a couple of years. And then he went back to his guard unit, and he came to me and said, hey, tell me a little bit more about this Becoming Your Own Banker program. I think I might want to do it. He's now a licensed life insurance agent. He's passed the Nelson Nash Institute practitioner's test. And you need a mentor as a new life insurance agent. He was foolish enough to pick his old man to be his mentor. So I'm training up another San Antonio agent, and I tell my clients, if I don't make it to 120, he's my continuity plan. So we keep mentoring them on how to put their policy to work, ultimately not just to buy back their debt, but to buy real cash flowing assets that are going to keep producing income and windfalls when they sell that are going to go back more and more in their banking system.
How much smarter do you think this is as a decision for people to make than over, term life, these low cost policies? Because it's short-term thinking that's going on now, but I just kind of scale-wise, it's like, it's 10x smarter to do this, or is it like, it's a little bit better or whatever? Just if there's a way to conceptualize how much better this is to make it attractive to people who are just maybe they choose to pay a little bit more or pay a lot more, but to really build an asset. It's an educational curve. That's what we're fighting against here. And people aren't going to move on it unless it's like almost ridiculously obvious what you should be doing here. Can you make it ridiculously obvious that people should be choosing this?
Well, I think I can, whether they hear it the way I'm saying it, but, the election is tomorrow. And every election they say it's about the economy, stupid. And the economy is pretty damn terrible, not only for the federal government, but for, as Howie said, personal finances as well. This modern experiment has turned us into immediate gratification consumers. When I was a kid, they had layaway. You go put some money down on something, you didn't get it until you went back over time and paid it off. Then you got your thing. And then credit cards came, and now you deserve it to have a great life. Everything went instant. They forget that there's a future them sometime in the future that they got to take care of. They can't eat or consume everything that they're making right now. And there are 3 financial fears for everybody, or they should have it, especially if they're accountable or responsible. It's number 1, what happens if I die before I've taken care of my wife and my kids and raised my family? So what if I die too soon? How do I take care of them? Well, this covers that. It multiplies that premium into a tax-free death benefit. The second fear is, well, what if I get injured and I can't go to work? So disability insurance is important. And this over time will replace disability insurance. I mean, as you save your money in this account, well, and especially if it's your 6 to 12 months of emergency fund and you don't spend it all, like I did in South Carolina when the interest rates went up and I couldn't pay off those 24% business lines of credit because I put it all to work. Well, I don't do that anymore. And then the third fear is that you're going to outlive your money. So the first 2 most definitely taken care of once you start the Becoming Your Own Banker program and stick with it. And eventually the disability insurance is covered as well, all 3 of those fears. So some multiple, I mean, at least 10x. And then when you throw the healthcare benefits into it as well, I mean,
seems like teaching entrepreneurs this would be a really good avenue, because it has that borrowing ability there. Plus, as an entrepreneur, solopreneur, you're worried about, these things you're just talking about.
That's right. And when you want to go try and borrow money as a new business owner and you got no proof of income, there's nothing coming.
Yeah.
So to capitalize your system before you take the leap is a smarter move, but you just start wherever you're at. I can help my clients, prospects, design a good system for them to get started.
Is this something that a business can do for their employees? Can they pay for the policy?
If it gets into getting tax write-offs again,
No.
No.
You're going to have to pay taxes on that money. Dang it.
That's right. Yeah, so you don't want that piece. Now, the full Becoming Your Own Banker program, what Nelson teaches on page 71 of the book is that this is supposed to be a generational program. So he says in most cases the grandparents have the money where their kids raising their grandkids don't. So the grandparents might take out a policy of $3,000 to $5,000 a year on a minor. And you can get a policy on an infant at 2 weeks old. And if that's compounding for 18 or 20 years, and if grandmom and grandpop are teaching their grandchild how to use this thing to buy the things that the kids want, but then has them repaying it, once they determine that the child is responsible enough, they can gift the policy to the child. And they have a banking system, and this thing's been compounding for years and years and years. That could be the capital to start a business as an adult. But if you get the grandparents insured as well, somebody in the family is going to die.
Yeah.
Somebody. From the kid to the grandparents, that's a windfall of a big death benefit that then fills up everybody's policy loans, potentially buys more policies. And if you can teach it into your family, that's generational wealth, and you'll never use a bank again.
All right. Well, we're going to be wrapping up soon. Alan, look like you're sitting on a question over there.
Oh, I'm sitting on lots of questions because this is all just very fascinating, but I did not have a specific one in mind. But thank you for asking.
All right.
Yeah. So if somebody wants to get an MBA in finance and investing, where do they reach out to? How do you want to close out the show? I love this. This is a topic that is, it's very true, but sometimes I think you need to reach the 6th floor to see the value of this, because, certainly when I was in my 30s, I was like, I just make money and spend it, and then again, like you said, that hitting yourself on the head, had I done this earlier, can imagine how different my life would be now, my financial life would be now, and having that financial freedom, really on steroids. So thank you for sharing that information. Much needed. I agree with Mark, something entrepreneurs really need to learn, because we're all going to need money to do investments, and certainly, like you said, the biggest asset we have, we're sitting on it, but also the number one thing we can all invest on and should be investing in is ourselves. So if you can borrow money to get into other investments to make money and continue to pay the premiums, winning combination.
Okay.
I'll take a go back. I did have a question, which is someone interested in learning more, what's their next step?
So I'm going to go back to where we were before. This will be funny by the time we get out of it.
Let's do it.
I do want to point out, and I said entrepreneurs and small business owners, and I want to make it clear that our families are small businesses, and we don't think like that. And even if you're employees, you're still running a small business if you have a household and children. So this is right for everybody. I think this is the financial foundation for everybody. So I don't want to exclude employees or anybody else that happens to be watching. And if they haven't quit their day job yet, well, this is the time to capitalize and start building their system for the day when they do. And then nobody's going to lend to them because they can't prove their income. Right. And then the way that people can get in touch with me is our website is hqbyob.com. And the previous joke was that does not mean bring your own booze, but you will want to celebrate after you've started. Right. Now, I only use the website. There's a contact box at the bottom of it for them to enter their information. There is a free giveaway, and that website, by the way, takes you into the Nelson Nash Institute website. It's an educational website as well if they click on the menu button, and there's a Foundations of IBC video series. There are 6 videos that can be watched for free, and then they ask you to register and pay $49.95 to watch the other 8. I ask my prospects, watch the first 6, give me a call, tell me what hurt your head, let's talk through it. I'll give you my code, you watch the remaining 8 for free. So if they go to hqbyob.com, go to the contact box at the bottom and send a message, I want to watch the remaining 8 or watch the videos for free. They'll have to leave their telephone number and email address. I'll get with them and make that happen.
Right.
Love it. Well, that gave your contact information, so we just nipped that.
Good job.
So, yeah, great job. All right, Colonel Mike, thanks for coming in. I appreciate that. I think it was a great topic. I enjoyed learning about it and then having a discussion, kind of dialing in on some of those unknowns and just get some clarification there. So it is something I wish I knew about sooner, but I think it's definitely something that I should be exploring. I'm still young, So.
My first policy was done at 59.
There you go.
So it's
Never
not
too
too
late.
late.
You got
It isn't
time.
too late.
You got time, Mark.
It's
You
too
got
late
time.
for Howie, but not for everybody else.
Yeah,
The
it's
best
too
I
late
can
for
tell,
me.
we're all leaving this planet, and when we do, if there's a multiplication of a death benefit or premiums to a tax-free death benefit, that would be good to take care of our family.
Yes, sir. All right, as we wrap up the show, quick reminder, check out our latest podcast and catch a video version of the show anytime by visiting our website at satalkradio.com. That's going to be it for this one. You guys have a great week. We'll see you on the next one.